Hey everyone, and welcome back to The Explainer. Today, we're unpacking a second quarter 2026 earnings report from a company that operates on just a massive global scale. It's a really compelling look at how distinct regional challenges can actually be managed through a highly diversified business model.
We're talking about Coca Cola Femsa, literally the largest Coca Cola franchise bottler in the world by sales volume. They cater to over 268 million consumers across Latin America. When a company of this magnitude reports its quarterly earnings, it gives us a vital pulse check, not just on the beverage industry, but on consumer health across multiple nations. And let me tell you, this quarter's numbers are incredibly insightful.
Get this, they moved 1,071.8 million unit cases in just a 3-month period. That represents a very solid 3.5% increase year over year. To put that into perspective, a single unit case is equivalent to 192 ounces of finished beverage. Moving over 1 billion of those in a single quarter is just a massive logistical and commercial achievement.
Okay, let's dive into this. To understand how they pulled this off, here is our roadmap for today. 1. Consolidated results. 2. CEO insights and strategy. 3. Mexico and Central America. 4. South America growth surge. And 5. Sustainability and future outlook.
Section 1. Consolidated results. Let's look at their Q2 2026 performance.
So that 3.5% volume growth we just mentioned, it absolutely cascaded directly into the financials. That volume increase pushed total revenues up by 4.7%, and even more impressively, operating increase grew at nearly double that pace, jumping 9.1%. This shows us that they aren't just selling more drinks, they are selling them a whole lot more profitably.
Looking at the Mexican peso figures, total revenues hit over 76,000 million. Gross profit reached roughly 36,000 million, and operating income came in right around 10,654 million. The crucial point here is how they achieved a 180 basis point, or 1.8% expansion in their gross margin, bringing it to 47.1%. How'd they do it? The data shows it was driven by lower costs for sweeteners and PET plastic, supported by some incredibly smart raw material hedging initiatives. They also got a nice boost from the appreciation of their operating currencies against their US dollar-denominated raw material costs.
Section 2. CEO insights and strategy, a diversified approach.
CEO Ian Craig actually summed up the quarter perfectly with this quote: "We delivered a sequential recovery that highlights the strength of Coca Cola Femsa's diversified market presence." Keep this word in mind for me, diversified. Whether you're running a massive global company or managing your own stock portfolio, operating across multiple environments provides incredible resilience. It allows your strengths in one area to completely offset your challenges in another.
Craig also grounded the company's strategy in real-world events. He actually opened his remarks by expressing deep condolences and offering support for the victims of the recent earthquakes in Venezuela, showing a real commitment to the communities where they operate. On the commercial front, he highlighted how the company successfully leveraged the massive momentum of the FIFA World Cup. This strategic move strengthened their brand equity and heavily reinforced their connection with consumers during a globally unifying event.
Looking forward, a huge part of their strategy is digital. The CEO specifically pointed to their Juntos Plus platform and accelerating their digital agenda as a key initiative. Evolving their digital transformation and utilizing advanced revenue growth management capabilities are exactly what they are relying on to adapt to the rapidly changing consumer landscape.
Section 3. Mexico and Central America. Time for a regional deep dive.
So geographically, from a pure volume perspective, this region did well. Volume increased 1.4% to almost 646 million unit cases. They saw volume growth across all territories in the division, which includes Mexico, Guatemala, Costa Rica, Panama, and Nicaragua. However, as we look deeper into the financials, we start to see some pretty serious challenges lurking just beneath that surface-level growth.
Now, what's really interesting about this slide is the stark contrast. Despite selling more unit cases, their total revenues were basically flat, growing a tiny 0.3%. And the real shocker? Operating income actually declined by 7.0%.
So wait, why did operating income drop 7% when they sold more products? Well, their operating expenses simply outpaced their revenue growth, driving a 1.1% contraction in their margins. These higher expenses were heavily driven by increased marketing and freight costs. On top of that, the CEO specifically called out the ongoing effects of excise tax increases in Mexico as a major hurdle they had to navigate. Finally, they also reported a lower operating foreign exchange gain compared to the same period last year.
It was just a really tough operating environment, requiring heavy reliance on their affordability and segmentation strategies just to maintain their competitive position.
Section 4. South America Growth Surge. Get ready for some explosive Q2 results.
Because wow, this region delivered explosive results. Overall volume for the division, which includes Brazil, Argentina, Colombia, and Uruguay, jumped 6.9%, but look at these localized spikes. They achieved massive volume growth of 17.7% in Colombia and a very robust 5.2% in Brazil. Both of these countries hit record second-quarter volumes, completely wiping out a volume decline they experienced in Argentina.
And thanks to that incredible volume, operating income for the South American division skyrocketed 46.5%. Just let that sink in for a moment. You have a 7% decline in the north, perfectly counterbalanced and honestly entirely overshadowed by this staggering 46.5% increase in the south. This perfectly illustrates why massive multinational corporations design their footprints exactly this way.
The mechanics behind this success resulted in a massive 3.3% margin expansion. Unlike in Mexico, the South American division enjoyed incredible operating leverage, meaning their revenue grew significantly faster than their costs, coupled with really strong expense efficiencies in labor and rentals. Now, to be completely transparent with the data here, it's important to note that this 46.5% profitability spike also includes the recognition of a 265 million peso insurance claim in Brazil. But even with that factored in, the underlying operational strength in this region was clearly the driver of the company's consolidated success this quarter.
Finally, Section 5, Sustainability and Future Outlook. Let's talk about their future readiness.
Over on the corporate side, the company announced some key leadership shifts. Pamela Ortiz, who brings a ton of experience in capital markets from FEMSA, was appointed as the new Investor Relations Director starting August 1st. Meanwhile, Jorge Colazo, who previously held the role, is transitioning to a crucial new position as Strategic Planning Director for Coca Cola Femsa Brazil. They are undoubtedly looking to capitalize on that massive momentum we were just talking about.
The company also proved that their financial growth isn't coming at the expense of their corporate responsibilities. They actually swept the Mexican Stock Exchange's ESG awards. They took home the best total score in the Mexico Corporate Sustainability Assessment for 2025. They also won top distinctions for environmental and governance scores. As they noted in the report, these recognitions really reflect their commitment to creating long-term value through disciplined, transparent, and sustainable business practices.
And you know what? That long-term value creation translates directly back into the shareholders' pockets. Signaling their immense financial health, the company distributed a massive 4,065.1 million peso cash dividend on July 16th, which was the second installment of their approved ordinary dividend.
Which leaves us with this final thought. We've seen how regional diversification totally saved the day this quarter, balancing a tough market in Mexico with just incredible growth in South America. But as they move into the second half of the year, facing an ever-evolving consumer environment, the big question remains, how will their advancing digital transformation, like that Juntos Plus app, and their revenue management capabilities shape their ability to maintain this momentum? It's a fascinating strategic pivot to watch, and we'll certainly be keeping an eye on it. Thanks so much for joining me for this explainer, and we'll see you next time.